Imagine Daniel. Daniel bought his first Bitcoin in 2019. Nothing dramatic, a few $100s a month on autopilot, the way a lot of people started. By late 2025, without ever meaning to become a crypto guy, Daniel was sitting on a position worth just under $400,000. Real money, life-changing money, the kind of number that quietly changes how you think about your 30s, your parents' retirement, your kids' college fund. Then, in 11 days, it was gone. Not 11 months. Not a slow bleed he could have caught halfway through and course corrected. 11 days, and by the end of it, Daniel didn't have a shrunken position. He had nothing. No coins, no cash, no cushion. Just a liquidation notice, a zero balance, and a number that used to represent a house down payment, now representing nothing but the memory of one. Here's the part that should genuinely unsettle you. Daniel didn't get hacked. Nobody stole his seed phrase. No exchange collapsed under him. He made exactly one decision. One. That felt completely reasonable in the moment. And that single decision was enough to erase 5 years of disciplined buying in less time than it takes to plan a vacation. I'm going to tell you exactly what that decision was in a minute, because it's the fastest way to destroy a Bitcoin fortune, and it is happening to someone right now while you watch this video. But Daniel's story is only the opening chapter. By the end of this video, I'm going to walk you through 5 distinct ways people destroy life-changing Bitcoin positions, some fast, some agonizingly slow, and I'm going to show you which one is quietly responsible for more destroyed fortunes than all the others combined. It is not the one you're expecting, and if you've ever held Bitcoin through a red week, there's a real chance it already has its hands on you. Let's start with what actually happened to Daniel. Daniel's mistake had a name, and if you've spent any time in crypto trading circles, you've heard it thrown around casually like it's a strategy instead of a trapdoor. Leverage. Here's what that actually meant for him. Instead of holding his Bitcoin outright, Daniel opened a leveraged long position, essentially borrowing money against his own conviction so that a Bitcoin move in his favor would multiply his gains. At 10x leverage, a 10% move against him wipes out his entire margin. At 20x, it only takes 5%. Daniel was at 15x when a routine, unremarkable pullback, nothing close to a crash, nothing close to the kind of drawdown Bitcoin has produced multiple times in its history, crossed his liquidation price. The exchange didn't ask him. It doesn't work that way. His position was closed automatically, instantly, and the capital backing it was gone. This is not a rare, unlucky story. Industry write-ups on margin trading behavior, the kind published by trading platforms themselves, put the share of leveraged crypto traders who ultimately lose money as high as 95%. That specific figure comes from industry analysis rather than an independent academic study, so treat it as directional, not gospel. But even the more conservative, broker disclosure-based estimates agree on the underlying pattern. When ordinary people trade frequently, under pressure, with borrowed money, the odds are stacked hard against them. And when it goes wrong fast. On May 19th, 2021, more than $10 billion in leveraged crypto positions were liquidated in a single 24-hour window, forcibly closing over 900,000 accounts. The largest single position wiped out in that event was $75 million gone in one transaction. That part is well documented across multiple outlets. More recently, trading platform data from earlier this year describes a single $61.5 million Bitcoin long position liquidated on a 6% move, and a trader losing $220 million on a 10% Ethereum drop the same month, contributing to a reported $2.5 billion plus in total liquidations across crypto markets in a single day, figures worth treating as illustrative of the mechanism rather than independently audited totals. Here's the detail that made Daniel's story hurt more than most. He wasn't wrong about Bitcoin. He was right. The price he was betting on eventually got there. It just didn't matter because leverage doesn't care whether your long-term thesis is correct. It only cares whether your position survives the short-term noise on the way to being correct. You can be completely right about where Bitcoin is going and still lose everything because leverage adds a timing dimension that raw conviction can't solve. There's a specific mental tool for exactly this trap. It's called the sleep test, and it comes from a book I'm going to keep coming back to throughout this video because every single mistake on this list connects to it in a different way. The sleep test asks one blunt question before you size any position. If this dropped further from here, would it genuinely cost you sleep? If the honest answer is yes, you're not sized for your actual risk tolerance. You're sized for your ego's opinion of your risk tolerance, and those are very different numbers. Daniel never asked himself that question. Most people who get liquidated never do, because leverage is specifically designed to feel safe right up until the second it isn't. That's mistake number one, and it's the fastest. Minutes, sometimes seconds. But I promised you 5, and the second one doesn't require you to make a single trading decision at all. It just requires you to trust the wrong person with your keys. And it's worth being honest that this one is arguably scarier than leverage, because leverage is at least optional. Nobody forces you to open a 15x position. Almost everyone who has ever bought Bitcoin has, at some point, left it sitting on an exchange, even briefly, which means almost everyone has been exposed to mistake 2, whether they realized it or not. Quick pause, because I want to make sure you actually get something out of the next 15 minutes instead of just feeling uneasy for no reason. Everything I'm walking through in this video, leverage, custody risk, scams, lost keys, and the 5th mistake I haven't told you yet, is covered from a completely different angle in a book called The Bitcoin Holder Mindset. It's not a trading guide, and it won't tell you which coin to buy or when to buy it. It's built around one specific problem, the psychological and structural mistakes that quietly destroy Bitcoin fortunes that were, on paper, going to be fine. Daniel's sleep test failure, which I just mentioned, is a framework straight out of that book, and it's one of over a dozen tools like it inside. It costs normally $97, but here's the deal. If you stay with me until the end of this video, I'm going to give you a $50 discount voucher for it. That's real money off, not a gimmick, not a countdown timer, designed to rush you the way I just warned you about 2 mistakes ago, bringing it to $47, but I'm not going to give you the code yet. You'll get it at the end, after we've gone through the rest of this list, because the later mistakes on this list are, honestly, the ones that matter more, and I'd rather you sit with the whole picture before deciding whether the book is worth your money. Let's keep going, because mistake number 2 doesn't take 15 leveraged minutes. Sometimes it only takes one bad night's sleep from someone you've never met. In February 2025, the exchange Bybit was hacked for $1.5 billion in a single incident, the largest crypto theft in history, full stop. Not a rug pull, not a scam coin, a direct compromise of an operator's signing infrastructure. Attackers with the authority of a legitimate operator moved user funds out, and there was nothing individual account holders could do about it because their coins were never really theirs to control in the first place. They were IOUs sitting on someone else's ledger. Here's the number that should actually scare you more than the headline. Industry trackers estimate that when a hack happens at this scale, recovery rates for the people who lost funds fall below 1%. That figure comes from a single industry source rather than a court-audited accounting, so hold it loosely. But directionally, it matches what actually happened after Bybit. Once coins move through a sophisticated attacker's laundering pipeline, meaningful recovery for ordinary account holders is the exception, not the rule. And sometimes the danger isn't even a hacker. Sometimes it's just one person having too much control. In 2019, the founder of a major exchange called Quadriga CX died suddenly while he was the sole holder of the platform's private keys. No backup, no shared access, no contingency plan. 26,350 Bitcoin became permanently inaccessible, worth around $1.7 billion at today's price of roughly $65,000 per Bitcoin, and worth even more at the peak of Bitcoin's last market cycle. Not because of a hack, not because of a market crash, but because one person's convenience became every user's catastrophe. Every single person who trusted that exchange with their coins learned all at once the difference between owning Bitcoin and owning a claim on Bitcoin that somebody else controls. This is where the book's chapter 6 actually applies in a way most people don't expect from a psychology book. It borrows a mental model from the investor Charlie Munger. Before you trust any person or platform with something valuable, ask what they actually stand to gain and what happens to you if their incentives and your safety ever quietly diverge. Nobody at that exchange was incentivized to force their founder into a shared custody arrangement. It would have been inconvenient. It also would have saved every user's money. That's not a hacking problem. That's an incentive problem, and it's a psychology problem wearing a technical disguise, which is exactly the kind of trap the book is built to help you spot before it costs you anything. Notice the pattern across both halves of mistake 2. Bybit's users didn't do anything wrong. They picked a large, well-known exchange, the kind most guides tell beginners to use. Quadriga CX's users didn't do anything wrong either. They trusted a founder who, by every outward appearance, was running a legitimate business. In both cases, the mistake wasn't a bad decision made by the victim in the moment. It was a structural decision made months or years earlier, leaving coins somewhere other than a wallet only you control, that only became visible as a mistake once it was already too late to undo. That delay between the decision and the consequence is exactly why this mistake is so easy to make without ever feeling like you made one. The third mistake doesn't need a hacker at all, and it doesn't need a single point of technical failure the way a lost exchange key does. It just needs you on your phone for about 4 minutes, and it's getting harder to spot every single year because the tools behind it are getting dramatically better. Scam and fraud losses in crypto hit an estimated $17 billion in 2025 alone. Impersonation scams, someone pretending to be your bank, your exchange's support team, a government official, even a Bitcoin executive, grew by 1,400% year over year. AI-generated deepfakes are now driving $4.6 billion of that total, and here's the detail that should genuinely worry you. AI-assisted scams are roughly 4.5 times more profitable per attempt than traditional scams, because a convincing fake voice or video collapses the one instinct that used to protect people. That doesn't sound like them. Some estimates put the share of 2025 crypto scams that started on ordinary social media, Instagram, Telegram, X, as high as 56%. That specific number comes from a single industry summary rather than a cross-verified academic count, so treat the exact percentage as approximate, but the underlying pattern is well documented across multiple outlets. These schemes increasingly start where you already are, not on the dark web. And this isn't limited to clever phishing links either. Sometimes it's frighteningly physical. In May of last year, prosecutors say a wealthy Italian investor visiting New York was held captive for 17 days in a rented townhouse and tortured after his captors demanded the password to a Bitcoin fortune reportedly worth around $100 million. According to court filings, he escaped by telling his captors he would hand over the password, then bolted for the door the moment he was left alone, meaning the people accused of holding him got nothing, but only because he found one narrow window to run before he stopped being able to. The case is still working through the courts, and the men accused are entitled to a presumption of innocence, but the pattern it illustrates doesn't depend on the verdict. Large, publicly known crypto holdings make some holders a physical target, not just a digital one. The far more common version of mistake 3 is quieter. A fake customer support agent, a too-good-to-be-real investment opportunity from someone who found you, a countdown timer designed to make you act before you can think. Which brings up one of the sharpest, most reusable ideas in the entire book from Chapter 2. If a decision about your Bitcoin feels like it cannot wait until tomorrow, that urgency is itself the warning. Genuine, well-researched conviction almost never expires overnight. Scammers know this instinctively, which is exactly why every single one of these schemes is engineered around artificial urgency. A countdown, a final warning. Verify your account in the next 10 minutes or lose access. If your reasoning can't survive a 24-hour delay, the book's framework says plainly, it probably wasn't reasoning. It was one of the four horsemen: fear, greed, FOMO, or impatience, wearing a disguise convincing enough to fool you for exactly as long as it needed to. Here's the strangest entry on this list, because there's no villain in this one. No hacker, no scammer, no liquidation engine. Just you, a piece of paper, and time. Nobody knows the exact number because the blockchain doesn't flag a coin as lost. It just sits there, indistinguishable from a coin someone is deliberately holding for decades. But analyst estimates converge on a wide, sobering range. Somewhere between roughly 2.3 and 4 million Bitcoin, an estimated 11% to 18% of the entire 21 million supply that will ever exist, with some independent analyses running even higher, is permanently lost. Not stolen, lost, locked behind forgotten passwords, discarded hardware, and seed phrases that were written down once somewhere and then simply never found again. The two most famous cases in Bitcoin's history make the point better than any statistic could. Stephen Thomas, an early Bitcoin adopter, holds roughly 7,002 Bitcoin on an encrypted hard drive, protected by a password he can no longer remember. He has exactly 2 guesses left before the drive locks itself forever. James Howells in the UK threw away a hard drive containing roughly 8,000 Bitcoin during an office cleanup, years before anyone imagined those coins would eventually be worth hundreds of millions of dollars, and it now sits somewhere in a landfill, functionally unrecoverable. Neither of those men was reckless. Neither of them made a single trading mistake. Thomas didn't over-leverage anything. He set a password in an era when Bitcoin was worth a few dollars and had no reason to think a random string of characters would eventually gate access to a fortune. Howells didn't chase a scam or fall for a fake support agent. He threw out a broken laptop the way anyone throws out a broken laptop, years before the coins on it were worth anything close to what they're worth now. They simply never built a real system, the kind of thing that sounds boring right up until it's the only thing that would have mattered. Redundant backups stored in separate physical locations, a written plan for who else, if anyone, should ever be able to access the coins. A habit of treating a seed phrase with the same seriousness as a will, not the same seriousness as a post-it note. The book's Chapter 10 covers exactly this gap under something it calls the Personal Bitcoin Constitution, a single written document decided while calm, covering not just what you'll do during a crash, but the basic operational discipline, backups, redundancy, a plan for what happens to your coins if something happens to you, that almost nobody builds until it's already too late. It's the least exciting chapter in the book to read, and based on stories like Stephen Thomas and James Howells, arguably the most expensive one to skip. Boring, in this specific context, is not a criticism. Boring is what a system looks like when it's actually working. We're at the halfway point, and so far every mistake on this list has an external villain: a leverage engine, a hacker, a scammer, a lost hard drive, something you could point to and say, that's what got them. The fifth mistake doesn't have a villain. The fifth mistake is you on a completely ordinary Tuesday, making a decision that feels calm and rational in the moment and looks catastrophic a few weeks later. It is, by a wide margin, the most common way Bitcoin fortunes get destroyed. Well, more common than leverage, more common than hacks, more common than scams, and lost keys combined. And I'm about to show you the actual data behind that claim. Before I do, remember that $50 voucher I mentioned earlier? It's for the Bitcoin holder mindset, and I want to be specific about why I keep bringing it up here instead of waiting until the very end. The book normally costs $97, but with the voucher, you'll pay just $47. The reason I keep mentioning it is simple. Almost the entire second half of the book is built around the exact mistake you're about to see. The Four Horsemen framework I mentioned earlier, the sleep test from mistake 1, and the personal Bitcoin constitution from mistake 4 are all parts of one larger system the book calls the pre-commitment strategy. Because the biggest question serious Bitcoin holders ask isn't, what will Bitcoin do next? It's, how do I keep myself from making the one decision I'll regret for the rest of the cycle? Mistake number 5 is the answer. Stick with me until the end of this video, and I'll give you the voucher code that drops the price from $97 to just $47. What comes next is the entire reason this book was written. As of this week, Bitcoin is trading around $64,700 to $65,000, still roughly 48% below its all-time high of $126,198 from October of last year, though well off its own recent lows too. That gap alone is enough to put a lot of holders on edge. But the number that actually matters isn't the price on any single day. It's what people do about it, and Bitcoin's own recent history gives us an unusually clean case study. Bitcoin has now lived through drawdowns of roughly 84% in 2018 and roughly 77% in 2022, genuinely brutal multi-year corrections, and came back to new all-time highs after both of them. Earlier this year, during a sharp mid-2026 pullback, on-chain data showed a clear capitulation event, a 30-day average of Bitcoin sent to exchanges at a loss climbing toward roughly 2,450 coins a day, with monthly realized losses hitting a reported record of around $90 million, a figure that, at the time, exceeded every previous capitulation phase on record. Those weren't hackers or scammers taking that Bitcoin. Those were the owners, sending it to an exchange and selling it at a loss voluntarily. Here's the part worth being honest about, because a video like this loses credibility fast if it treats one bad stretch as a permanent state. By late July, that specific selling pressure had already cooled. Spot Bitcoin ETFs pulled in their first net inflows in 8 weeks, and net selling on-chain slowed to a small fraction of what it had been just weeks earlier. Markets breathe. Capitulation phases end, new ones eventually begin, and neither this video nor anyone else can tell you with certainty which phase you're reading this in the moment you're watching it. What doesn't change between phases is the mechanism underneath all of it, and that mechanism is worth understanding regardless of which week you happen to be in when you learn it. There's a name for this specific gap between what an asset actually returns over time and what the average investor actually earns holding it. The behavior gap, a term coined by financial planner Carl Richards. It exists because investors across every asset class ever traded by human beings, not just Bitcoin, tend to buy after prices have already risen when confidence is highest, and sell after prices have already fallen when fear is highest. That's the exact opposite of a rational, unemotional process, and Bitcoin doesn't cause this pattern. It just makes it larger and far more visible because its volatility compresses years of ordinary market emotion into a matter of weeks. Here's what's actually happening inside a holder's brain when this occurs, straight from chapter 1 of the book. A sharp drawdown doesn't get processed by your brain as a data point on a chart. It gets processed by a small structure called the amygdala as a threat to survival, the same ancient circuitry that once decided whether your ancestors should run from a predator. Under a sufficiently sharp move, something in the range of 20% and beyond, that structure can effectively override the calmer, more rational part of your brain that would normally weigh evidence and consider your actual time horizon. That's why panic selling so often feels like relief the moment it happens. You're not solving a financial problem, you're ending a physiological alarm state. The same way pulling your hand off a hot stove ends pain. The alarm was never really about your survival. It just felt like it was. This is also why willpower alone doesn't save people from this mistake, and this is a subtle but important point the book makes directly. Willpower is a finite resource that depletes exactly under the conditions a crash creates. The holders who avoid mistake 5 are not the ones with more willpower. They're the ones who never needed it, because they built a system in advance that doesn't depend on willpower at all, the same pre-commitment strategy. I mentioned a minute ago, built around something called a Ulysses contract, a binding rule set by your calm, rational self, specifically designed to override your future, emotionally compromised self the next time a drawdown like the one above shows up, whenever that turns out to be. Put mistakes 1 through 5 side by side and the pattern becomes obvious. Leverage, exchange collapses, scams, and lost keys all happen to a minority of holders in specific avoidable circumstances. You have to actually open a leveraged position, actually leave coins on the wrong platform, actually answer the wrong message, actually skip building a backup. Mistake 5 is different in kind, not just in degree. It doesn't require a single external decision to go wrong. It's available to every single person holding Bitcoin in every market condition. Because the only ingredient it needs is a nervous system reacting to a chart, the way nervous systems have reacted to danger for a very long time. No hacker has to find you. No scammer has to call you. Your own wiring does the entire job for free if you let it. And unlike the first 4 mistakes, you can't fully outsource the fix to better security habits. This one has to be handled at the level of the decision maker, not the account. So here's the honest version of the title of this video. The fastest way to destroy a Bitcoin fortune isn't actually leverage, even though it's the most dramatic and the quickest on a clock. It's not a hack, even though the headlines are the scariest. It's not a scam, even though the growth rate on those is genuinely alarming. And it's not even a lost hard drive sitting in a landfill somewhere, even though that story never stops being painful to hear. The fastest way, measured not in minutes, but in how many people it actually happens to, is a single bad decision made by a completely ordinary person on a completely ordinary red day who never built a plan while they were calm enough to build one properly. That's not a market problem. That's not even really a Bitcoin problem. The same behavior gap shows up in stock funds, in gold, in real estate, in every asset class ever traded by human beings with nervous systems. Bitcoin just makes the pattern larger and harder to ignore because its volatility compresses years of ordinary market emotion into a matter of weeks and gives you far more opportunities per year to make the mistake than a slower moving asset ever would. It's a psychology problem, and it's the exact problem the Bitcoin holder mindset was written to solve, not with price predictions or trading signals, but with the same frameworks I've referenced throughout this entire video: the sleep test, the 4 horsemen, the personal Bitcoin constitution, and the pre-commitment strategy that ties all of it together into a single system you build once, while calm, instead of trying to invent one during the next crash. If you watch this whole video, you already understand something most people holding Bitcoin never actually confront. The real threat was never just external. 4 of the 5 mistakes on this list can happen to you through no fault of your own. The 5th one is entirely yours to prevent, and it's the one most likely to actually get you. The Bitcoin holder mindset walks through all 13 chapters worth of frameworks referenced in this video. The amygdala hijack from chapter 1, the 4 horsemen from chapter 2, loss aversion, and the reference point trap from chapter 3, anti-fragility, Stoic philosophy, the historical pattern across every Bitcoin cycle, and the full pre-commitment system that closes the book, the sleep test, the Ulysses contract, the personal Bitcoin constitution, and the identity statement that makes all of it permanent instead of temporary. It normally sells for $97. Because you stayed until the end, you can get it for $47 using the code holder50 at checkout. That's the full $50 off I promised you twice already, once at the 3-minute mark and once at the halfway point. The purchase is backed by a money-back guarantee, so you can go through this material yourself and decide whether it delivers real value before committing to keeping it. Daniel's story, back at the start of this video, ends the way it does because nobody had ever asked him the sleep test question before. That's the entire point of building the system before the storm arrives, not during it. The same logic that would have saved Stephen Thomas 2 guesses on an old hard drive, or given a Quadriga CX user a reason to ask why one person held every key. If you've ever watched Bitcoin fall and felt that specific urgent pull to do something, anything, right now, this book was built to help you recognize exactly which of the 5 mistakes on this list is trying to happen to you, and give you a plan that was already decided before the feeling ever showed up. The link is below this video. Use code holder50 at checkout for $47 off the regular $97 price while this offer is running. One last note. Because credibility matters more in this niche than almost any other, every statistic in this video was pulled from named, dated sources rather than invented for effect, and where a number came from a single industry source rather than an independently audited count, the leverage loss rate figure, the sub 1% hack recovery estimate, the social media origin share of scams, I said so explicitly rather than presenting it as settled fact. The capitulation data in mistake 5 reflects a real event earlier this year, not a claim that it's happening at this exact moment. Markets move, and a script that pretends otherwise doesn't deserve your trust any more than a chart that pretends it only goes up. This video is general commentary and education about Bitcoin market history, security practices, and investor psychology, not financial, legal, or tax advice, and not a recommendation to buy, sell, or hold any specific asset. Market conditions, prices, and cited figures can change quickly. The criminal case referenced in Mistake 3 involves pending charges. The individuals accused are entitled to a presumption of innocence, and the account given here reflects what has been reported by court filings and law enforcement statements, not a final legal determination. Anyone acting on anything discussed here should verify current data through primary sources and speak with a qualified, licensed financial advisor before making any investment decisions.